Okay, so I think we're live. Thanks, Guy, for waiting. We're a bit late. So, yeah, I'm happy to have this webinar today. We know with We Advanced, we released a lot of stuff and we wrote a lot of text, and reading text can be boring. So the idea today is just to go over some of our new stuff, and just to explain and put some emphasis on the stuff we think that are probably the most important, and explain them. Naturally, we're not going to be able to cover the whole content of the blog, so I assume we'll take question at the end, probably at the end of each section. We'll go, but anyway, we'll take question and we could answer them, but probably also you could go after that on our blog posts dedicated to each section to dig a bit more into those indicators. So just before we started, since it's probably been a year and a half since I did our last webinar, and probably more than that, just wanted to introduce a bit myself, and Zackary will do the same. But so I'm Vincent. I'm the Panda in chief that wrote you most of the blog posts for the last few years. So I'm a university professor, specifically in robotics, signal processing, and AI. I'm in Montreal, Canada. So I'm also a founder of Robotic, which is one of the leading company in collaborative robot space, which is a topic outside. So I'm not going to go into what is a collaborative robot, but anyway, it's a tech company. So I've been a founder. I've been in that company for 18 or 17, no, close to 18 now years. Yeah, so I've been involved in finance. I've been an investor since 2008, which was a pretty bad year to start, but a pretty good learning experience. And yeah, I grew more into that as time passed. So yeah, just a quick story, just for the more recent member. The whole member probably know me, and I had time to explain that a few times. So Zach, maybe you want to say a few words about you?
Yes, so I met Vincent as a student. I was one of his students. I was doing my master's degree in collaborative robotics also. And at the end of my studies, I was trying to start a startup in the electric motor domain. However, that led nowhere. Anyway, that's not the point. I started on the side working with Vincent on the Wealth Umbrella on many projects, bringing some of my programming background up to the task. And then I just asked him if I could jump all in. And that's why I'm here since August full-time. You might have seen a few projects go a bit faster since now I'm here. We have a bit more bandwidth than Vincent had on its own with Nathalie. And as an investor, I'm not as experienced as Vincent. I just finished school. I did not have much capital, but that's a subject I've always been interested in. I invested my small portfolio since a few years now, and I'm eager to always learn more, deep dive into the data, and always try my best to reduce risk while investing.
Yeah.
So
if I can just add, Zackary was not my typical random student for two reasons. So not only was he a very good student, but also he did his master on a topic on signal processing, was mostly algorithmic. Although it was applied to robot, it was really about signal processing. He actually used algorithm from the finance world. He used kind of Bollinger Band and other advanced math stuff, but yeah, it was not like he didn't came into Wealth Umbrella completely randomly. It was pretty much aligned with what he did with the company he was working with during his master for the 2 years before joining Wealth Umbrella. So anyway, yeah, that's a quick story. So now let's go for We Advanced. So the idea of We Advanced started around giving more signal It's something that I said before is I know we already bonify the offer of the SP500, and up to a point that a lot of people start to get lost into our signal. And I said it in the blog. It's something we'll also address in the next few months, giving more info, more tutorial about how to use them, but also probably create better boundary. But I really felt that at some point, having more signal for part of our community was probably not better. So, but I knew that on the other hand, we had a lot of very good investor and people that really love data and are very, I'm always impressed by stuff that I read. I'm really, genuinely. So, and I knew that there's other signal to work on. I wanted to share them, and I found this way to share them with you. So yeah, without much more waiting, we'll just start about what is inside our advanced page, because one of the pages is really more market signal. It's more like what we do in SP500, but with more content outside of just the SP500. So just start with the box down. Here is the sector outperformance map. So basically, we look at each sector of the SP500 and try to evaluate in terms of statistic where they are, how they perform. And I think as an investor, it's one of the important points is to understand if the sector is in the right trend. We all probably remember in 2022 how the energy sector became incredibly good in a year that was pretty bad for the stock market. I remember doing my tax at the end of the years, and that my best position were all related to energy. So it's not the case now, although with what happened yesterday, it could be in a close future. But if you look recently, the star was ARC. Typically, ARC is not a sector of SP500, but as I find that it lacked the growth sector, which is very important for retail investor, I decided to make place for ARC. And anyway, we had we still had one place in that matrix. So yeah, it can help you spot what is overperforming and what is underperforming, and if it's the time to jump in on the ship or not. And related to that, we did the sector rotation quadrant where it show you where the current sectors stand. So they are clickable. So XL key, which is the tech sector, as you see, it went from lagging because during the recent drawdown we had. So that's the line is the last 3 months. There's a bit of noise as we just select some point along those lines. Maybe in the future we'll filter them. But you see that tech went from lagging to improving and are right now the leading sector in the stock market in the SP500. One other thing is you can look at how one sector perform against another. Here they are all against the S&P 500, but here you can do it against any other sector. I'm gonna go into later down this tutorial today a bit what is behind that curve, what is the map, in what you see. But I think this one can be very useful to spot where the strength is. And just to give you a concrete example, you might remember last November, although we're always into UPRO and SPY, last November I decided to go into TQQQ, and rapidly, although we jumped part in UPRO and TQQQ outperformed considerably UPRO, and the reason was my reason for jumping into TQQQ was that tech was in a downtrend since mid-July, and it was about to go into an uptrend. So looking at which sector and where each sector stands, I think can help you make your own choice about where it's probably better to go when the market bounces. So that is for the sector. This one, you might have seen it. We used it in January when we had I would call it the Christmas 2024 drawdown, and which was relatively minor. And then we reuse it in real time recently. So it's what we used to call the buy the dip indicator. We changed their name for a different reason, and one of them is because it's when you know that's probably the bottom of correction, there's probably other thing you want to do instead of just buy the dip. So we thought it was misleading. An example is taking out your hedge. Anyway, so we call it them now downtrend exhaustion. So the dashboard, you have three different signals. This is the three signal we have. I have a last one in the pocket that might be released by the end of the summer if it passes all the tests. But those three look at different points of the market. And the reason why I provide more than one is, first, I think buying the dip is hard, because if you look at that peak, for example, the big red one we had, it was really a bloodbath in the street. I think we all wanted to sell actually instead of buying. So I think having more indicator can help for the confidence. But the other reason is that when I was designing them, I made them incredibly restrictive just to be sure that they don't spike in the middle of a correction. So they are very restrictive. So sometimes they're so restrictive that in some more minor correction, they could not trigger, which is one possibility. So having more have us sure that we are covered. And each of them have different color. The first one have three different color. The other one have two different color. And it's also to go with the expectation of the correction. So don't expect to see a red one when you have a minor dip. Expect to see more a blue one when it's already a lot of candle. Volatility is relatively moderate, and it still hurt being there, but don't expect to see a red one. And on the other side, if you're into a strong correction, like we did add before the red spike we had in April, the last one was actually the bottom of the 2022 correction, which was in that candle. And by the way, don't get me wrong by the amplitude of that candle, because the reality is we normalized them. But just having a red one like that, even if it's not a big one, it's incredibly strong signal. And that was actually the red signal for that correction. So yeah, so you have access to the trader one, and since buying the dip is in the context, at that moment it's all empty, but you will start in real time to see when we will be in that situation again somewhere in the future, each reading for the day here and the reading in color for the last 10 days. So it helps you to assess rapidly where we are. So yeah, that's buy the dip, and then I put it under signal that I use as an investor. First is the volatility trend. The volatility trend is an indicator that I made that are really resilient to change. So they more capture the volatility environment. So for example, after being like for a year, so at the end of 2022, we switched back into the green zone, so the low volatility zone. And we stayed there until July last summer in 2024. And so usually when it's switched to an environment, I don't expect it to see it bounce. And so there's a yellow zone, is the transition zone. So way to play that is if you know that it doesn't flip-flop, yellow can become a resistance, and so a point of buying, shorting, but also knowing that we are in a yellow or in a green or in a red environment can help you choose, for example, not having leverage for people that don't want to risk into red environment. Because when we switched it in July, so that indicator existed back then, and I knew when it switched it to red that we were there for months. So it's almost a year now. If you look at the story of the signal, a year is usually how long they last. So I really expect, I don't know what happened yesterday, but I was really expecting now to see it flip successfully flip into the green environment. But it's not an easy time right now in the market with all the politics, so we don't know. But anyway, the other one is the SAM rule. I just wanted to have a clear way, an easy way to see it. There's this recession fear that are here since 2022. So I think right now is under the spotlight. Maybe if we have a recession after that, I could take it out of that dashboard. But at that moment, I think we want to look at it. So basically, you have the SAM threshold. So we are considerably over that threshold right now, but you might see it going to the SAM threshold. And there's the WEU threshold. If you have read the stuff we wrote about that, a year ago, we said that SAM threshold was arbitrary. There's some value of the different value of threshold that will yield the same result, and that the best threshold should have been 0.61 instead of 0.5%, which was probably a round number for. And the point is, since then, the SAM threshold failed. First time to use it, but the WEU threshold still stands. So what you can expect to see is when we will break the SAM rule, it will goes into the yellow zone. And then if it continues to move, it will go into the red zone. I expect, honestly, that next time we break it, it's probably going to be a recession, just the SAM threshold, because the ends, if you look at the statistic, we knew she could be wrong, but she's not going to be wrong many times with that threshold anyway. So, but yeah, we put it the two threshold. And the last section is all these historical trade. Actually, we made a modification yesterday. We took out the 4 best trade of the hedge signal. And so there's 4 other trade that ended up in a lot more profit. And the reason why we took them out is to give more view. We felt that putting them into the graph didn't give us a lot of view into where we are regarding to most of the trade. So just know that there's 4 best trade that are not displayed here. But the point is, the idea here is to show you what to expect. And so the hedge will never, or almost never, there's some possibility that could happen, that it would actually trigger on a market top. There's instance in the past that was not necessarily after a strong red candle or something like that. I'm thinking about November 2021. But the thing is, usually you will start to see some pullback before the edge trigger. So sometimes if you see that in very quickly, you are highly in profit over all the other trade in the past, that could be a good indication to, I don't know, take profit in some stock or start to cover some position, or maybe flip your TQQQ position into a QQQ. I don't know. I mean, we advance it to give you tools to make your own choice, but that's some way to play it. So here you see in time what you should expect. So at that moment, the trade is like right in the middle. It's not outstanding. It's just right along the stat, partially considering the amount of day we have been in. But if we ever see the red dot over the other one, over the other dot, we might take profit. And here is the statistic distribution. So right now we're kind of the center mode. So yeah, that's really to give you more tools to make decisions. So that is for Market Advance dashboard. That's more related to market, not the individual stock. And the rest of the stock that we'll cover is related to individual stock. So maybe it's like it could be a good time to take some question, if there's question related to Advanced dashboard.
Yes. First, there's a question. That arc is not on the middle sector rotation quadrant. That's something that slipped through while developing on the final sprint. So this will be added in the coming weeks. So that just to clarify this point. Then we have a question. I guess it's for the DE1 market pattern exhaustion. Beta Bull is asking if the red signal is better than the orange and the orange is better than the blue one.
Yep. Yeah, definitely. the thing is, it was very nonlinear. It's all related to the same equation, but it's so nonlinear that if I would all put that on a scale and give you a right scale to see the red one, you will barely see the other one. So we split it. We split it the range of the signal. We make it more linear and split it into three tier. So definitely a red one is incredibly strong. And by the way, the one we had here, when you look into the history, I think here we only have 8 years of history. But if you look into TradingView, you have more. Whenever you see it at that level, is incredibly strong. So yeah, it's definitely more strong. And but I could have, if I just filter it out to just have the red one in most correction, we will it will not have trigger. So, but you know, there's one indicator that I want to make. It's not there, and it's something that I find that it's not that hard to assess is how strong a correction is. And I'm not talking about it. I mean, it's normal that it's when we are at minus 20%, we can assess that it's strong, but it's really about how the volatility on the way down, the amount of times we're on the way down, and how quickly we go down. And so usually it's relatively easy to know that, like in April, if you remember, you probably don't even remember what was the drama in April 24 for that pullback, but I remember it. And so we knew it was not like the end of the world. And so it would be relatively easy to assess that. Don't expect a yellow and a red signal here.
Great. I guess that answers it pretty well. We have Ram that asks, which direction does the SAM rule threshold move? That's a good question, since it only moves once a month when the on-rate value is published. What's moving on the SAM rule Wu edition indicator is the green bar. So the greener you see it on the right, the further it is from the threshold. And when it would be dead center, which would be no bar, we would attain the SAM rule value, which would guess from SAM that we are in a recession. And then the line would fill orange up to the Wu line and then become red after that. So that's the way to read this indicator. We then have Indo about the sector rotation quadrant graph. The blue lines can be displayed by clicking on the little black dots. This is available for anyone. It's not an upcoming feature. It is already there. And it highlights it goes back a week for each point and draws a line drawing the movement for the past it's the past 3 months, I think. So that's it for it. And I guess that's all. There's Daniel that would love for us to go further into the trend. If we could go through a simple example of how you would look at that given this dashboard, that would be helpful. Same for an individual stock like Apple. So the next part of the presentation will actually be going through our stock-related tools, and we will use different stock as examples. So I think you will be answered there.
Yep. I will let you talk, Zackary, for the retail momentum screener, but yes. I just want to say a few words. So when we thought about Review Advanced, there was some stuff about advanced market signal, but also at that moment, I was working personally on a project of retail momentum. I wrote the story, but it started almost 3 years ago about this idea to use the fact that stock that retail love usually have a more predictable momentum and lead to run. Actually, it started with one person that I collaborated with, that around the idea of we have the tech upstart and affirm run. If you remember, and around the end of the summer 2021, those two stock that were not super well known at the time became incredibly popular and had a very strong run. So could you redetect it? And I started to work with a new data set released by NASDAQ that tracks this volume. They made it after GME thing. So I think institutions started to want to be able to track that. So it started around that, but then all the question of, okay, yeah, if I find some run, then how do I hold that stock? How do I invest when I take my profit and all this stuff? So we built it upon that idea, and it's where we added the stock L and tune map that we'll talk after. So that is the story of, and is the reason of those three different part of that software. So retail momentum, it's mostly Zach that I've done this interface. I will let you talk about it. I will, Zach.
Yes, let me just share my dashboard directly so that I can control it. If Vincent, you could stop sharing yours.
Yeah, sure.
Are we seeing my, Vincent, are you seeing my screen?
Yep. Yep.
Okay, perfect. First, there was one last question that popped up while you were talking, Vincent, so I just want to clarify this one before going forward. Betable is asking, is the current trade are just Woo trades? That's on the advanced dashboard. And yes, those trades are basically playing long on the edge signal directly. So it's not even our trade, it's the edge signal trades in context. Also, Etienne asks, how do you monetize the sector performance graphs? Would that be backward looking only? This may be more a question for Vincent, but I think it's more to look at if a sector is overly outperforming, that may be a sign of overeating, that we might return back to the mean sometime soon, but sometime the market can stay irrational longer than us. So I guess that's just an indication of the current situation. And also the same, but inverse is right also, a sector that is really underperforming and that through our own analysis, we might think that it might be coming up, may be a good indication that, again, we might reverse to the mean and come back a bit stronger in the future, but there's nothing predictive in that. Maybe Vincent, you want to add something on the sector?
No, but yeah, I think you got it right. I mean, we express it in standard deviation for a reason, that anything above 3 standard deviation never really lasts. It's the nature of a statistic. So maybe 3 standard deviation. So for example, me personally, I wouldn't jump into ARC right now at that moment. We'll probably, but it's not necessarily because it's at 3 standard deviation that we're gonna pull back more. It's just we could see it going more in line with SPY, or going more in line and cooling down. So yeah, it all brings down, and I think it's the same thing when it's minus 3 standard deviation, but then it's all about catching a falling knife or jumping into an oversold, and it's all about your risk tolerance. But yeah, it's always this thing about being oversold, overbought, but the stock can remain oversold or overbought for long. So it's not that easy to the predictive value is not exactly, you see it at 3 standard, it's a sell thing, but yeah.
Good, perfect. And final thing before going into the stock, Kevin is asking if we could create annotated chart on the advanced market chart, and to help understand how to read each chart. That's actually a point I want to mention, because our next step, now that our advanced offer is live, is really to improve the help section of our platform. We do understand there's a lot of signal. They're all to be understood in different ways and to be used in different ways. So our next objective is, as Vincent mentioned, is to publish multiple videos explaining our tools, and also to add to our website in order to make it clearer and easier to use. So now I'll just jump right in the retail momentum screener. So first, as Vincent introduced it, the idea behind it was, how could we have spotted runs such as Upstart back in the days, where, as we can see here, the first big uptrend of Upstart. I think even, well, the poster child of this is definitely GME, that did something just incredible a few years ago. They even made a film about it. And that's where we ended up on this data set that helps us see the retail participation in the market. So how did we package this into a tool? First, we defined our flags as a run, what we call a run. So the idea behind the run is to look at the flags not by themselves, but as a group. For example, if we look at Upstart here, we can see that there's a whole bunch of flags near the start of the run. And then we have a few ones that are near the top that would be bad or not as good trades. And if we were to count them individually, we would have like a bunch of very good trades that would increase our average gain and make it seem like the tool is better than it really is. Because it's kind of all one big trade, and each flag is increasing our confidence or showing how exhausted maybe the retail is as keeping jumping in. So that's why we package it into a single run. And what this does is, in the latest flag section that we can see up here, each line on this table is a run in itself. So a run is defined as the first flag within 100 calendar days from the previous flag, or if there was no flag, well, it's just the first flag. So if we start on the first flag here, we count 100 days calendar and look if there is another flag. So if there is another one like here, we keep going forward, and again, there is another one before 100 days up until this final one. And then we have a huge period where there is no signal. So the run is considered ended, and that's how we defined it. 100 days is not random. It's just enough to catch the next earning, because we found that there is a lot of flags that are aligned with earnings. Retail is looking at this, it seems like, to jump in or out of a stock. So having a period that was shorter than a quarter made it so that there was a lot more runs that were counted. So this one and this one would be counted as a different one, and even this one. So it led to we were more looking for mid-term trades than short-term buy and sold in a few days. Then for the table here, what we have is a few stats. First, the count is the number of flags that happened since the first one. The first one being on the start date here, and the latest one being on the latest date that is highlighted. And the table is ordered by the latest date. So you always see at the top the flag that happened the closer to today. So for example, yesterday, because we only have the data the next morning, we have seen that WBD flagged for the 7th time since May 28th. So if we look at WBD, and on this case, it's the first flag since its IPO, or since we have data. If the data set goes back up until 2016, I think. So as we may see, well, WBD flagged a whole bunch of times in a short term. Then we have the gain and the max gain. The gain is if we take yesterday's price, because the price action on those graphs is only updated at night. If we take yesterday's close and the open before the start flag. So as I said, the first flag is only known the other morning, the day after. So to compute our stat, we use the open of the next day. Even though it might not be, like in this case, it opened higher and then fell, we still use that value since it's the earliest we could take action on that signal. And then we compute the gain we would have as of the close of the last day. So as you see on the WBD would be with a slight loss. And the max gain is the gain computed from the highest closed within the run. And finally, the warning. I think there's a few questions as to what the warning means. So first, the snowflake are to highlight sectors that have shown to have less volatility. I'll call it like that. There was a clear distinction between a few buckets of sectors that had lesser, well, the wins were a bit less, and the losses were also more contained, which means we saw it at the inverse at first. Like there was some sector that showcased really big returns, but also really big losses. But it was easier and I think more logical to show it as the coolest sector. And that's not to say that those sectors cannot have big runs. If we scroll down, SMR, for example, has even close to 40% run. And I have seen like IMS, yeah, that's the one I was looking at. You can have like 200% runs as a quote unquote cold sector, but on average, it is less likely to happen. Then we have the yellow triangle with an exclamation mark, W. This is to highlight a big price movement just prior to the flag. So WRD is a good bad example of it. We have seen that up to a certain threshold, if there was a too big of a move upward or downward prior to the flag, it often led to, or rather, I would say the worst runs would happen when this situation occurred. So why wouldn't we just filter those out? Well, there was also incredible runs that started like that. So when we looked at filtering them out, it actually didn't change much of the statistics because we were removing at the same time some of the best runs and some of the worst one, making the average not move a lot. And we felt like it was a better idea to simply show a warning stating that this is a high volatility flag, because we would not want to not flag one that could go on a run. But those are to be taken with a bit more caution. The counter example is LVWR. That's just one I found prior. There's plenty of examples, but as you can see, there was a big jump, even almost tripling in value within 2 days. And finally, it doubled once again after the signal. So it's just to show in 2 examples why it's not always bad to see this, but it's just riskier. And the final warning is the red circle with the exclamation mark. This one is simply to highlight smaller market caps. Those market caps, it's 100, 800 millions. Those, again, tended to either go to the moon or to the grave, but if I can say. But we again wanted to highlight those as being risky plays that could go off high, but also could go down to really big debt. Now I'll go across the statistics here. So those graphs may look confusing, but we felt it was important to have them beside the flags to always remind you of what are the statistics of each run being a success. First, the statistics are computed as the maximal gain attained by a stock within the period. So that does not take into account if it dipped below before attaining that top, or if it dipped really badly after attaining the top. So playing this game would be for perfect traders, and that does not exist, but it still shows the opportunity that there is when using a flag. So for example, when reading this chart, we have here the 1 year period. What we can see is that if we go at 50%, so here it's the 30% maximum gain. So we have that 46% of all runs flagged go above 30% within 1 year. This is useful because you can have a better understanding of where your current run is compared to the average run or the median run. You can also see the buckets here under. It's the same value but splitted as the bins of the value that stand exactly between 0 and 10. So the dots here are actually just the sum of all of those. For example, if I were to be between 0 and 10, well, all of those other buckets are also included in that value since they all went also above 0. So that's also to show where where much of the runs ended up to be, which is between 10 and 20% in that case, and it goes almost to 0 at the end. As you can see, there's a 0.34% of run that reached 200% within a year. And then we have the maximal gain reached as the average and median. The median here is really important because, as you see, there's a few outliers that go really, really high. GME, I think there's a 2,000% run. This makes the average bigger than it should be, making the value 51% for a year too big for nothing. If you were to say, oh, in average, we reach 51% gain at max, you would probably be deceived because if we look at a 50% year gain, there's only 29% of runs that reach above 50%. The average here is misleading because of those outliers. And that's why the median is an interesting value to look at. Here we have 27%-ish as the median. And the median is just the middle value. If we take all of the runs and we order them by the max gain they would reach, we just take the one right in the middle. It means that there is exactly the same amount of runs that did better than 27.35% that did worse than 27.35%. So those two, the median help put context in to the mean, to the average, and this is why we have plotted both on the same chart. And finally, I received a few questions asking how to use this retail momentum screener, and we do understand that by our decision of using warnings instead of filtering out, we created a tool that has many flags. So there's like 3 new flags on the 11th, 1 on the 10th and 9th, so that's not too bad. But there's some days like the 4th where there's just so many new flags, and it can be confusing to decide if I should go in, out, or whatever. And first, going in or out is always your decision on how you feel the stock can go, your analysis and your research. But we think this tool is, or at least that's how we use it. It's more like a way to draw attention to companies, to tickers that could have an interesting run. So when we see a new flag, so each morning I just go on this page, I look. So this morning I went WBD, and I went on the stock L that Vincent will present next to look at the company, and then I decide if I go for it. So it's just a way for me to maybe discover new stock and decide if I believe or not it would go on a run. I would not suggest just going on every single of those flags and trading every single of those flags. I would have to actually compute if that strategy would work, but this is not something we will be doing on our side, at least. So I guess that does the round for this product. I have not looked at the comment section, Vincent. I don't know if you've seen any questions.
Yeah, just hold on.
Okay, Betable, I see you're asking to let us filter this table. This is a comment I've received from, maybe it was you by email or somebody else, but this is something on our list to be able to order by any of the columns. I will be looking if it's easy. Maybe it will come sooner than later. So it's on our list, and we will add this on the time coming.
Yeah.
Vincent, maybe you can answer.
No, yeah, but there's one for the snowflake. Would be nice to have an explanation on site when you put the cursor next to it. Yeah, that's probably kind of stuff we could add a bit like when we go into the information things. So yeah, good suggestion.
Yes.
Yeah, so maybe I will continue. Oh, Etienne's asking to clarify the gain is measured post flag. So maybe you can answer.
Yes. Yes, exactly. So the gains are computed as a long position that enters on the following open from the first flag. So when there's a flag, the next day open is the entry, and then we update the gain throughout the days, and the max gain from all of those days is logged at the max gain column. And Eric asked, at a high level, what causes the signal to flag on a given stock? We're looking at the retail participation in the stock, and we're looking at outstanding participation from the retail inside this specific ticker. So when there's a big influx of retail interest in the stock, it is when it would be flagged on this table.
Okay, so maybe anyway, if there's other question, we can answer them at the end.
Yep.
So I will continue with the stock health. So if you agree, I will share my screen, Zach.
Yes, go ahead.
I think you have to unshare yours.
Perfect.
So let me go to the dashboard. Yeah, so no matter if you discover a stock with the retail momentum screener, or if you heard of a stock on Twitter or any other way to discover a stock, and you want to assess if it's a good position or not, we made it a page with some signal we love. So the idea is you're not going to find all the information. If you go to Yahoo Finance, you have about everything you could dream of. And by the way, it's something that I said in the blog, but personally, when we went into financial, we had some difference sometime that created a lot of problem with trading View Financial. And every time we checked in actually the real earning file of the company, we found it that our number were good. So the API we use, the data we subscribed are very good. But we found it that Yahoo Finance was also mostly always good, unlike always trading View. So just I want to mention it because it's something you might want to know, something I didn't know first. But the idea here, so was not to put everything, was to put a metric that I usually look. And the idea was to get a clear, rapid overview if the stock is investable or not and what to expect. So for the technical is relatively simple metric. It's just MACD, RSI. Sometime somewhere down the road, they will be clickable and you'll be able to see where's the MACD stand. So right now it's bearish for Apple, as Apple is kind of in a downtrend compared to the stock. But yeah, there's the RSI. The BAA, I will come back when I will talk about the market neutral price trend at the end. And also give you the range, if it's inside of the range, and where the SMA 50 and SMA 200 stand. They will change color if you go into more trending stock. If they are, not yet, but I would assume that maybe HAP is... Yeah, so if they are in the right order that we usually like them, they will be green. So just going back to Apple. So here, the valuation, their revenue multiple. So partially, if you're into growth stock, it's probably one of the most interesting metric. We always hear about the EPS or But I think for growth, the revenue multiple is something very interesting. So I'm as being involved with startups. It's maybe something I didn't mention, but beside being university professor, due to my background with company, I'm involved with many startups. And so in the VC world, the revenue multiple is always where actually the negotiations stand with company. And it's usually in exchange for growth. So usually depending on your growth, for a young company, you will go and come in more premium into the revenue multiple. So it's something that I look at. This is a signal we'll had in the next coming week is how this revenue multiple stand against the story of the stock. And the reason for that, I will give you this example with Shopify. So Shop has always been a very expensive stock. I think it came down. It came down a lot, but if you look to Shopify, for a long time it was like 30, 40x, which is very high valuation. So on my side, I personally mostly always stay out of Shop except for some momentum play, and the reason was I was not comfortable with the valuation. And the thing is, I was probably wrong because Shop remained for almost 5 to 6 years into that very high revenue multiple zone. So maybe looking at it today, we could say that no, actually I was right, but no, I think that when a stock stay in a position, a very high position for 5, 6 years, it has its prime. So the point is, looking at the Z score, where currently it stands in history, it helps you because some stock like that always come in more premium. So looking maybe if you think of Shopify in 2021 or in 2019, probably seeing it at 16x, if that happened, it was probably a huge discount and a good opportunity. So that's something we'll have. The PE ratio, everybody know it, the EPS, and the rule of 40 that is not as well known, that is usually used in transition company. So the idea is for a pure growth play or for a startup or for a company, a tech company, young tech company, we expect it to see more growth, and you actually don't want to do profit for a while. You want to reinvest your profit to fuel your growth, but come a point where you need to start to make profit and having a balance of them. And before going into more mode where you actually create that profit and where the revenue multiple will go down, there's this transition zone. And something that is relatively well known is the rule of 40 is it was mostly used in software company, but that a company that has growth, so you add the growth in percent and the profit margin in percent. And if a company is over 40, it's a good company. So just thinking of a company that I know personally, HubSpot, that was good for a while and was above the rule of 40 for a while. Recently, it's not going as well, and that. But also, if you look at Nvidia right now, it's still very high, and the reason, like, although it trade as a huge premium, the fact that the rule of 40 is so high, it shows you that it's probably not as much risk to buy it as a premium, because it means that the revenue, if it continue on the same trajectory, it will rapidly, the price you pay will be a discount compared to the future. And because it's also doing like profit and also increasing the revenue. It's not alone to decide, because the idea then is that growth is sustainable and how long it will last. But still, that show you that if the growth lasts, it's probably not that expensive at that price. The other one is the financial. One of the first stock that I checked when we made it that interface was Lucid, as was relatively, there's a lot of talk about like they have cash flow problem and they're losing a lot of money. So it's not surprising that you will see a bad picture there, and NVIDIA. So the bankruptcy score are 3 different models that was published in the academic world. So all of them have their strength and their weakness. So that's why we went for three, as there's not one single one that will work for every company. So I encourage you to dig more in my post where I wrote more a bit about what their strength and what are their weakness. And the DuPont tree is a way to, it's kind of very restrictive, as if a company not do very well into one axis, the return on equity will be highly penalized and will go into the red. But it's one way to see how healthy a company is. The earning is just some of the data we prefer. We'll add some, and the analysts for those that take attention. I think it's personally interesting before earning to understand rapidly what we expect. Then I'm going to jump into more what we put into the L data. So here is more to assess, and this is, it can help to assess, but there's other data that, for example, the beta of a stock, it's something you want to know, just to know what to expect in your portfolio if you go into that stock. So just for those that don't know what is the beta is, it's really a measure of volatility, but how much you should expect to be the volatility compared to the volatility of the S&P 500. So it's not necessarily the return, because the stock could go sideways and having a given volatility that respect is beta. But the point is what you expect in terms of volatility compared to just holding the market, market being the S&P. So then I put it the ATR. That is something that I really use. So ATR stands for average true range. It's a measure of what you should expect as a move for a stock. So for example, as of today, considering the volatility of the past few weeks and historical volatility, you should expect one standard deviation should be $4.25 for NVIDIA. And there's different way. ATR is often used in institutional trading to give equal size of each trade in terms of potential loss. So the point is, if you invest into a stock that has in percentage a lower ATR, maybe you can take a bigger trade because you will risk the same amount of a smaller position into a stock with a very high ATR. So at the end, you have different size of position, but they all have a similar risk in terms of losing on volatility. And a lot of people sell actually at 2 ATR. And what you can, it's not exactly the same, but selling at 2 ATR is like 2 Sigma. I don't know if you know that firm, probably one of the most famous quant firm on the planet called 2 Sigma. And the reason is 2 Sigma is the statistic sign for standard deviation. And 2 Sigma is usually 95.4% of the population. That's 10 between minus 2 Sigma and 2 Sigma. And so it's usually when you go outside of 2 Sigma, it starts to be abnormal. Bollinger Band also trade at 2 Sigma. So let me just share another my trading view, because so one of the way that ETR is often used is a lot of institutions actually sell at 2 ATR, put a trading stop loss at 2 ATR. So it's a way to capture and to be sure to keep most of what have been done. So next week, I will work in making available more script and for trading views. So this one, so probably in a week, you will have access to them. So that's one that I made is in blue, you see the line of where actually the 2 ATR stand. So you see that here, NVIDIA is personally a position that I took. It's something that I've been in before, but I took it recently during the recent drawdown. And you see that we went close to the 2 ATR line. I actually also have Micron that I jump in around here. And you see that sometimes we touched it, but we didn't breach it. But usually when you breach it, it's often the end of the trend. If you look here, if you had been in NVIDIA, you would have escaped most of the bad red candle up to this one. and then he would have been out of that stock. So that's one way to play. So I think it was although it's just a small number here, I think it's something that can play a good role. The other one is the dark pool activity. I'm going to go back to sharing the dashboard. So dark pool activity is something we used to be able to do in TradingView to map for every stock. We cannot do it anymore in TradingView. So with our API, we can. At that moment, you only have 1 year of history, but we'll bring it up to 5 or 8, I think we agreed. With Zackary, is just we have to work on a workaround because it's only the last year of data are available like that. But yeah, anyway, we'll do something probably in a month. But yeah, the idea is to know what is the level of selling of dark pool. The 2 line here are the threshold we use on QQQ in the edge strategy. So we put it there. They are back tested for the edge, but not necessarily for every stock you have here, but just wanted to put there as an indication of so if you would trade at 2 sigma would be because that's its standard deviation of the volume. So we will give you more history and also give you the capability to track the stock chart. Actually, you have it under it, but we will make it over it to be able to track exactly each spike corresponding to what movement. That's something people ask it as we lost the ability to track the dark pool on TradingView. And the last one is one of the signals that is probably something that I use the most for individual stock for a while is the market neutral price trend. So here, the idea behind that signal is to remove the market influence. So I would just give you this example. If we go with NVIDIA and in 2022, around November, well, let's say around January in 2023, most of the stocks started to bounce back. So January 2023 was a pretty good month for stock. Everything was going up. But if you think of a stock and you know the beta, you should expect like NVIDIA, right now we see that the beta is 2.12. So you would expect that when SPY in average do a move of 2%, to see a move on NVIDIA of 4.24%. But so we remove that influence. So we adjust by the beta and the SPY, and we look, the result price trend is really how the trend is for the given stock. And the reason I think it is important is you can really see what is related to the stock and what is related to the market. Because at the end, we have the hedge for the market, and being in a stock, if the stock is going well, is the stock is still a popular stock and remain aligned with its own with the market trend, it's okay to write it down into a small correction, and it will bounce back. But the point, what we really want to avoid into individual stock is to stay in a ship when the ship is sinking. And yeah, that's what we can observe here. And I made it the TradingView version of it. Let me just again stop presenting and share my screen. So, for example, when I decided to enter Micron, I was seeing that it was starting to outperform the market, what it should have done, considering its beta, and that line was going there. So I traded around here. And as you see, Micron continued to outperform the market. So although the market went up since there, if you look, Micron around here was 80, and now it's almost 120, and which is not bad considering the volatility of that stock and the beta of Micron. But also you can use it to capture really big trend. Here I configure it in the indicator just to see a sector. So if you were an investor before the COVID, Cathy Wood was doing TED Talk and was doing our talk basically around like people don't love growth stock because they're scared of it, but it's what matter. But at that time, that was aligned with the fact that ARK and the growth stock was in a downtrend. And then a bit before COVID, it started to pick up some steam. And if you remember, during COVID, partially in the middle of the drop, ARK started to outperform because there were a lot of stock that was related to what would work during COVID, stay at home, and if you remember in 2020, she won the best ETF fund of the year, the best stock manager, and you see the uptrend. And although the stock market peaked really at the end of 2021 around Christmas for a lot of stock growth, partially the most aggressive risky growth aligned with ARK started to peak in February. So you see that since then, if you have been riding ARK, it didn't went well, although it started to less outperform. And after almost 4 years of drawdown, ARK just started to flip green again on that trend. It's not a massive euphoric trend, and it's the reason I was not surprised to see it in our advanced dashboard going into 3 standard deviation right now, because I know that ARK might have at that moment the proper factor for going up. And actually today it is green, while if you don't follow right now, Nasdaq's about minus 0.8. So yeah, it's really to see how the stock is performing naked of the market effect, and to help protect against. So and I think it's one of the very powerful signal. It's actually something I would present TuneMap after that, and it's something we'll probably bring into TuneMap, as I think I want to have a signal that I would just edge on when the market starts to outperform, knowing that I'm anyway protected with the hedge for when the market's turning. But so what is actually for directly the influence on a stock? And probably if I go look on Tesla, you will see when the EV trend started to peak and started to not go as well. So this is here. So actually in 2022, Tesla did relatively great in the drawdown against the market, and for all 2022, actually it was trending up until around September, and then it really went massive down, and for very long until last fall. Tesla was mostly in a downtrend, aligned with the AV trend in general. Okay, so yeah, that's it for the stock L. So we only have TuneMap to cover. So Zach, is there any question?
There was a question about the ATR period. I answered in the chat, but it's 14 days that is computed, which is the standard. And then, if used in TradingView, does the period of 14 adapt to time frame on screen like hours, days, weeks?
For the screen, for which script?
For the ATR script, I think.
ATR is calculated. Yeah. I will check. It's not published yet, but it's a good question. ATR for me was always something to use on the daily frame, as it's usually you take the ATR of the day before. So yeah, just by the way, just a precision, ATR is not a constant thing for stocks. So for NVIDIA, it's $4.25, but tomorrow that number will change. So I usually always use the ATR of the day before to apply on my stop loss. But what would be the effect on a minute chart? I didn't try it, but I will actually let you try, guys, and be sure that it will work on that time frame before I release the script.
All right. There's also for market neutral price, a green line means starts to outperform market.
Yep.
And red the contrary.
Yeah, exactly. And I'm just gonna share again my trading view, but I made the script in a way that you can actually change a configuration here. It's like for the configuration, so you can change and see the MA length, the slow and the fast EMA length, and I put it also a hysteresis zone. So if you want to play with a stock, looking at how in the past it behaved and what would be a good trend indicator on that stock. So in the dashboard in itself is the, I don't remember actually, Zach, what is the standard configuration? But I would bet maybe we could come back on that, but we cannot change it at that moment. It was on our plan to be able to make it configurable in the dashboard.
Yep, that's something that could be coming up. We have a question about the dark pool spike. Could it be either positive or negative? And what is the difference between the fully lined and the dotted one?
Yeah, okay. Yeah, in the hedge, we have two thresholds. So one is, I think the exact number is 3.9. At 3.9, it's a good indication that there's something. So in the edge, it's not going to always go through. It will depend on other condition. And if we breach the 5, if I remember, is 5 exactly, that's line. In the hedge strategy, it's automatically trigger a hedge, no matter what are the other condition, or mostly out of those conditions. So those are the two thresholds in the edge. Again, those are back tested for the edge over, I think we have about almost 20 years of history of dark pool data on the edge, probably a bit more. So those are the threshold for the edge. I'm not sure they will apply on all, but it's still standard deviation. 5 standard deviation is a lot, is about the IQ of Einstein related to the normal population. So you don't see that very often.
Perfect. There's a follow-up question. What if it's a dark pool buy? If we
by the way, one of the question in the negative, it's really it's usually spike in a positive, you see, and you will see actually the dark pool activity is relatively complex, particularly as market maker do purchase on dark pool. So for example, and it's the reason I did not separate the short and the long position into this. So that's the aggregated thing, because sometimes when you see a spark of short, it's mean actually a very big buying activity, and people, the market maker, need to edge their option, bullish option position that people take by being bearish, so they short on the dark pool. So there's actually paper that has been written on that short on the dark pool is bullish, but it's not always. So I didn't decouple it. So it's pretty hard to see a sell and a buy. Although partially when you come to the market, there's no such thing necessarily as a spike and a buy, but it's usually a spike and a sell. But for individual stock, actually it can happen. So it's the reason, like, you really need to look at the stock history and what happened. And usually if it's bullish, if you see a spike in the stock at a bullish news and a good day, it's usually more encouraging. And if that happened on a sell-off, that's probably a very, very bearish news. Okay, so anyway, if there's other question related to that, we can jump on them at the end of the presentation. I will jump into TuneMap.
Yes, I saw the time is running out. It's always already 1 hour and 15. So we can go wrap TuneMap, and we'll
personally, TuneMap can take some time. So just want to be sure that everybody understands TuneMap, because I'm not sure that everybody has ever coded in TradingView. But the point is, in TradingView, for example, if you want to code a 2 EMA strategy, you have your code, and here I'm testing on the stock Snowflake, for example, a 9 and 14 strategy, and then I compile it, and then it runs, and then give you the stats. So in the case of Snowflakes, it would be a pretty bad strategy, as the buy and hold. Buy and hold will be losing on the 10,000, so it will lose 19%. But using a 9 and a 14 2 EMA strategy, I will lose almost 60%. of my capital. So that's not a good strategy. So then if I want to explore, I need to change them. And then I could try, instead of 12, for example, a 14, and then run the strategy again, and then look at the result here, which actually I went from almost minus 60 to like something more around minus 50. So that's probably better. And I could play with that and go up to 22, and eventually I will go to 22 and 29, and I would find it's pretty good strategy here. So while I was losing 60% of my capital using a two EMA crossing strategy, setting on when they cross bullish and when they cross bearish, I would find that with snowflakes using a 22 and a 28 is incredibly good strategy. And so, but the point is, finding them is you need to try them, and it can take. So the idea of TuneMap was to make it pretty straightforward to see. So it's something we were doing internally before for validating every threshold. So if I go see snowflakes here, we pre-compute it, and you will see that 22 and a 29 strategy is near the optimal. So basically, let's start by that. Here's the return, is the amount of time you outperform the buy and hold. So more red, strong red it is, better is that position, more optimal is that configuration, and more going to black or very dark blue, it's a very bad configuration. So if you look at the first configuration that I tried was about this one, and like I said, it was around minus 60. It's not this exactly same period, so number is not exactly the same, not right now. And we were underperforming the buy and hold, while when I go back to my 22, 29, it's a pretty good strategy. So it's a way to visually see exactly where we are. Usually what I will choose is optimal point, but optimal where it's kind of in the middle. So it's something that I showed years ago in presentation about intrinsic entropy. I show a bit our reasoning that if you find, because sometimes you could have just a small point around here or here, it's usually you want to be in the middle of an optimum. And the reason is that if stock behave a bit differently than in the history, it should lead to similar results. So yeah, and then you can see for each point what are some of the stat, and partially the hit rate, but also the amount of trade. The amount of trade is something, for example, I'm really not I know that some of you might have times or might love to trade very often. I'm not very good at trading each day, so I'm not usually go into a configuration where I will trade a lot, many times per week. So I usually more like a holder. So I would be perfectly okay with that given strategy. Then you have this other thing, this simulation filter. And just to explain it, and I think it's one of the important things to understand. I did a couple of slides. It's, let me just, okay. So just go into full screen. When you invest, there's only one certainty, is that the trajectory of the past will never repeat exactly. So it's not because you tested a strategy on this past, thinking that it's going to work as well in the future is utopic, because it's never going to rehappen. And when you test a strategy in TradingView, there's not much thing you can do to test it in the future. So one of the solutions that most people use, and that we also use at Wealth Umbrella, is the hold-out period. So usually you will test on a stock a certain amount of time, and then you will test it in the last 1-2 years of the stock history. One of the reasons usually we have a holdout period is overfitting. Okay, here it's an academic example for AI, but I think it's relatively easy to put in context here. Let's say you have green dot and you have blue dot. Let's say green dot is you should edge, market's not going well, and blue dot is you should be in the market. It's what you want to do with a strategy is to trace that frontier where you're able to separate those two as best as you can. But sometimes there's some overlap in the data, and it's not perfectly possible. So although on the left side, it would be probably the best frontier you could draw, if you have a complex strategy that can overfit, and any complex strategy will do that, it will start to trace a very strange boundary that actually encompass all those dots in the right order. But although the result of on the historical period will be awesome, that line doesn't make sense. And when you will get new dot along that line, it will probably very often misclassify those points. So that is what we call overfitting. I made this quick example. You don't really need to understand AI for that. I use the TensorFlow sandbox for that. The TensorFlow is the AI API for from Google. But anyway, this is just here. I put it like the most complex that sandbox data that I could do. It's separated data here that is still again like just think of the orange one as we need to edge, and the blue one we need to be in the market. So there's some overlap. And although the frontier would be easy to draw with a pen, that it should be, since we have a complex network, it can overfit. So it can start to create very strange orange zone to try to grab those dots in the middle. And that is overfitting, because probably if you have a blue dot in the top orange zone here, you should still call that a blue, but it will call it orange. And that's not what you want to do. And that's its overfitting. And that's the reason why you usually want to test to be sure you don't overfit into a period you didn't touch. But the thing is, when you have very simple networks, so the edge strategy is complex. So it's very important. There's 4 years, it's 5 years now, that has been untouched for the edge strategy. It's just real time. We never use it for back testing because that's very important, because there's a lot of criteria, parameter, and that could easily overfit. But the thing is, when you have a very, very simple strategy, like in this example is one neuron is tracing a line in the space, and like it cannot overfit. It's just a line. And the thing is, when it comes to tune map and we talk about technical indicator like a 2EMA strategy, a MACD, RSI, it's very simple things. It's just line that are filtering of the price and the cross. It's pretty hard to overfit. So it's not about overfitting. So the fact that we don't necessarily have a holdout period, it's not a problem with overfitting. The issue is not overfitting, is exceptional historical event that can distort the optimal result. And I will give you this example. If you remember last summer, in July, CrowdStrike caused a major global outage. So, and stock went minus 50% in a few days, about minus, I think it was minus 49. Those things was completely outstanding behavior for CrowdStrike. It's something that is highly unlikely that it ever happen again. And the thing is, it will completely shape the optimal map. So if you look here, is the result in tune map for CrowdStrike. If you look here, you see all that point of optimum. If you click on them, you will see that they are all strategy that sold very, very early and that jumped back in a ship relatively at a lower price. There's some that went even better than that. So any strategy that would have worked well, even though they don't work as much well in the regular behavior of CrowdStrike, will create outstanding return. So they will highlight it. And that is one of the things you really need to be careful. And particularly in a stock that has particular event that were outstanding in their past, incredible jump on earning or stuff like that. So its effect you will not see as much on Apple, Microsoft, or more regular steady uptrend stock, but stock that has major drama, you will see them, and it's pretty hard to trust the return map. So it's really this thing you want to shield when you use, because a 2MA can barely overfit. And a holdout period would not be that great for that, because holdout period of a 1-2 year, because you need some year to backtest. You don't want to go 10 years, because the behavior of a stock 10 years ago is probably not a good reflect of what it is today. So you don't want to go. So let's say you go 5 years for training your strategy, testing your strategy, and then you have a holdout of 1-2 years. Would not really help you much, because you will only have, maybe depending on the strategy, how often you trade, you could end up having only 1 to 5 trades in that validation set, and which will have very limited statistical validity. So what we did, and what is usually done in the institutional world, is using Monte Carlo simulation. Is basically we simulate, we model the behavior of the stock, and we simulate 10,000, 1,000 in our case, different other trajectory. And what we use in our case, just for a person or more tech, is JGR Garch. I'm not going to say the name here. And what JGR Garch do is it's model the stock volatility behavior. So that's the Garch, is the fact that volatility come in cluster. So as you know, VIX rarely only spike for a day. It's usually spike, and then so it really come into cluster. So that's the Garch part, that the generalized autoregressive conditional heteroscedasticity part of the model. And the GGR is the volatility is asymmetric. So volatility is not the same on the way down. So it's usually that it is on the way up. So here's the COVID drop, and you see how quick it was compared to the uptrend. So volatility is asymmetric, is not the same. So that is the model we use. And the result of this is really, it's really real trajectory we get. It's similar trajectory. Here is one that I took for Apple. I took it randomly out of 10,000. So there are 5 years of daily data we generate, and to them, sometimes we'll have like this one. There's a 25% fast crash. They have like a year-long bear market, and they will model the behavior of the stock very well. If you look, here is a Fubo, which was very high volatile stock. So you see in red, in blue is the historical realized volatility, and you see one trajectory here that I calculated the realized volatility. So they match pretty well, those realized volatility. Unlike Apple is lower volatility, and then the simulation will be lower volatility, and the way that volatility moves is also pretty similar. So it's pretty identical. It's trajectory of the stock it could have, and so they each represent 5 years of price action. They are each unique. So here you see for that simulation for Fubo had a more euphoric uptrend, and then that's the realized volatility, but that was like relatively high volatility here and lower volatility here. So different trajectories. So we use those 100,000 simulation, and the things that allow us to do that we can do with this is, sorry, just I have an issue with the software. So do you still hear me, Zach?
Yes, all good.
Okay. Okay, Zach, I think I have an issue. If I click on that, it will restart the software. Could you share actually a tune map?
Yes.
I was at that point.
There you go.
Because it's to reconnect the camera, restart studio. And if I click on that, it's okay. Can you override the fact that I share my screen?
You would have to stop. Let me.
Because I can't.
I do not know.
Okay.
Okay, I guess we'll have to try to click on that. I do not see the option to kick your share screen. No, we still see your. Yeah.
Okay, well, I think I'm back. So I will so go on CrowdStrike for example. Actually, I will just unshare. I will I think I can.
Yeah. Okay, now we see my screen.
No, but I will share it. I think it's more simple as I'm back into.
Okay, perfect.
Sorry for those technical issues. We use a new software and it still seems to have some bug. But yeah, just hold on. I have. Okay, I'm back on that. Okay, sorry for that. So yeah, if I go to CrowdStrike now, so what we do is we use the Garch, and it generates a different map. And the fact that it's thousands of territory, it's more continuous map. And as you see here, we created a filter that overlap the return, and it will deactivate the zone, like that zone that was the optimal before. Deactivate it and then show you what should be probably the most optimal zone you should have considered. And that's probably if CrowdStrike would have never had this bug issue last July. That's probably the map you would have seen, something more close to that. So in that case, you probably want to be more into those point of strategy here. So that is for CrowdStrike. There's other strategy tool, different strategy. For example, phase angle. Phase angle is an indicator we did almost 4 years ago now, more than 4 years ago now. It's really captured the momentum. It's something that will tend to work very well at the market level. And the reason is that on a stock, momentum kind of changed. Sometimes stock in part of history is kind of unknown, so there's not big momentum. Then it became known, so bigger momentum. But if you look, for example, at TQQQ with the phase angle, and you would choose like the optimal threshold around here, it would match TQQQ return. But will provide you some good edge. Would sell here and then buy here. We have sell in last summer correction and buy here, and we give you some good threshold for good, and still shielding you from some drawdown. So that is there's other one. There's the MACD that I will cover because it's a bit. It's a bit different than the other one. So let's go to Snapchat. So on Snapchat, on the MACD, you see that the simulation, the Garch simulation return is something pretty similar to the return as the map kind of highlight the similar point. We'll deactivate a bit that area, but we'll strain at this one. But let's pick an optimum here, like that. The MACD Plus fix some of the MACD issue, less lag. We use different thing, something we call double EMA or zero lag EMA, which are not necessarily zero lag. And we also scale it the amplitude. So if you look, unlike conventional MACD, they will tend to oscillate in the same range no matter how the price was different back then. So it can also give you the information of where you stand, or how much oversold you are. But and the last point is hysteresis. Is one of the main issue with MACD, and same thing with 2EMA. So we'll probably release somewhere down the road the 2EMA strategy with hysteresis. Almost anytime we use 2EMA, we put this hysteresis zone. So one of the main issue of having two lines that can cross is when the market goes sideways, they kind of cross very often, but you don't necessarily want to shield from that. They cross because market goes sideways, they are close to, but it's not because they go into drama. So once you choose a point of optimum here, you can compute these hysteresis. And the reason we ask compute is here, just making those map require a lot of computing time, and we do it for almost 5,000 stocks. So it take days to make all those map. And for each of the point, there's also another map of hysteresis. So alpha and beta is the width of the hysteresis zone. So so anytime we will have to compute those 4 factor, and this would be hard to display. So it's the reason you do this in 2 separated steps. So you choose one point and then compute the hysteresis, and then you see if you can improve. And you will see the hysteresis zone often boosts the return, not by much. It happened, but it's rarely like 2-3 multipliers. Usually something around what we have here is multiplied return by 1.15 or something. But the thing that I love, it's usually lower the amount of trade. This is maybe not the best example as we're 12 trade and go -2, but sometimes you have strategies which are something like 40 trade inside of the last 5 years, and then you bring it down to something like 20, which is completely changed. Partially for me that I don't like to trade that much, and I think less you trade with the same return is probably more confidence you have into the strategy. There's one thing though. This might be the optimal point or close to very the optimal point here. It doesn't mean that when you compute the hysteresis that the optimum combination of it is not, it's exactly the optimum of all the system. So what I mean here is maybe you have a point here that the hysteresis return would boost it. I think, yeah, I found that example that the hysteresis return, no, because it was a lot more bad. But the point is, it's something we do in algorithm. Usually when there's too many parameters to scan or to display, it's for example, genetic algorithm. It's what we do. We take good configuration, and then we start from that good configuration to explore other parameters. It's a whole field in itself, and it's one way until we have quantum computing easily available, which will be good at scanning a huge amount of parameter. It's something we do. So, but still, it's usually will give you just like a better point. So like that for Snap, the buy and hold return was -52.7 strategy return, so it greatly outperformed. With these hysteresis, it did improve a bit, and it lowered a bit the amount of trade. If you want probably lower trade, as soon as you're here, you go a bit into lower trade. But again, it's not the best example. Sometimes you can cut the amount of trade by 2. So yeah. So yeah, that's pretty much cover what I had to say about TuneMap. It's something that personally, it's something we're doing on almost every indicator. We made it for Wilt Umbrella. So we decided to make it as, if you're going to individual stock, it can help you build strategy that fit your investor profile, and also that could help you protect your capital. So I really hope you like it for as much as I like it. Well, that's pretty much the end of it. I will take more questions. So maybe there's TuneMap. Yep.
Yes, there's 2 questions about the statistics. So if you may, I might just go across all of the statistics.
Yeah, sure.
To my screen.
Yeah, I let you present your screen.
Perfect. Give me a second.
Yeah, we see your screen.
Perfect. Okay, so first, all the statistics are computed from the long positions only. So a trade is defined as a buy and a sell signal. We did not compute the sell to buy signal in this section, since we think that shorting is well, it could be a good strategy, but not for everyone, and long only is maybe the normal case. So first, the normalized returns is the same as this map. It's basically by how much the return of the strategy outperforms the buy and hold return. The hit rate is simply the number of trades that ended up with a positive return over the total number of trades. which is the total number of trades, is below here, so 7. The buy and hold returns is, well, it is what it is. I mean, the returns during the buy and hold period, and it can change. I've received a few emails asking about this, and I don't think it's the place to go over exactly all of why we did it that way. That I will point you to our blog post that explains all of it, but the entry and exit of the buy and hold can vary slightly depending on the strategy we've chosen. And this was to prevent some tail end skew that could occur when, let's say, the strategy ended on January 1st after a big upturn, even though the actual exit would have come at a much lower point in a few weeks later. That would like save a good trade in the strategy return, which would amplify the return and make it seem like it's better than it is. So that was the gist of it. I strongly suggest that you go into the blog post to really read why we did it that way. Then average win loss, it's
actually Zach,
self-explanatory. Yes.
Okay, sorry. If you allow me, I responded to a question on that last week, and it's very deep into the comment section. I will just repost that response on top of the comment in the TuneMap post. But I gave more precision, and I think that was in the blog post. And I think it's an important topic, like why it changed and why we had to do it this way. And believe me, it's the optimal way. But it could bring some issue, but yeah, so you could go after the webinar in the comment section. I will post it on top of the comment.
Fantastic, good idea. Then yeah, average win and average loss is pretty self-explanatory, and the ratio of both is also. Now buy and hold period and strategy period. Well, strategy is the time in the market for all the trades combined. And the buy and hold period is, as we've said, varying across different strategies just to have a better comparison. Buy and hold drawdown is the ultimate drawdown seen during the buy and hold period. So it's maybe not the best one to show it quickly. I'll go with Snap. So for Snap, the buy and hold period, we take the highest point achieved. So let's say it would go up, then we would take this, and the drawdown here would be the maximum drawdown up until that point. And then it keeps going up until the peak, let's say it's here. And then we would compute the drawdown up to the lowest close, which I think would be this one or maybe that one. And that would define the buy and hold drawdown. Some of you may have noticed, I think there was a question about the max single trade drawdown. We changed the name due to a comment we received, and the stat that is displayed here is the maximum drawdown within a single trade. And I mislabeled the name so that it could be confusing. It's not that the statistic is not good, it's just that the name made it seem like it was something else. So what we compute here is that within a single trade, so if we take the buy and sell, let's say this one, we take the drawdown within the sell on its own. So if, let's say, at this point, it's the highest point achieved up until the entry, we would have the drawdown here, and then it would keep going up. So from this top up to the sell, which would be down there, I think that would be the max drawdown, and that would be, if it's the biggest drawdown within each trade on its own, it would be the value here. We will be adding the strategy as a whole drawdown also here in a few weeks' time. This true max drawdown, strategy max drawdown, would be directly comparable with the buy and hold. This one is more to see the worst case in a single trade. So if I enter position, the worst position you could have entered would have seen minus 36% during the position. However, it does not mean that it was a minus 36% loss. It might have recovered after. So, I don't have an example here, but sometimes there's a big dip that did not trigger the strategy, but then closed a bit higher. So it's good to use the strategy to have the trade in context when you're in a position and you know that maybe if you've reached minus 36, you're probably like the furthest down you could go. Even we can always be surprised. And if you're a lot higher than this, let's say you're minus 10%, it can give you context as to how bad it can become. And finally, the average wins over the median win is exactly the same reason as to why we displayed it on the retail momentum screener. Sometimes a huge win can make the strategy very good, but make it seem like it's better. So if we were just to take the average win of 33%, we might think 34 almost. We might think, oh, every trade might be 34%, but mainly there's one big trade. Here, that's a pretty good example. There's this huge trade. I guess it's that one that does like I don't know how much, maybe 3 times or 4 times. And then all the other wins are much more contained. So this ratio being high shows or highlights the fact that one or few trades amplified the average win, and it's to be taken into consideration when going in the trade. So that does it all. I guess there's the MACD. When you compute the MACD, there's also the value here that are updated. Return multiplier is simply the normalized returns, the new return computed as a multiplier of the normalized return. So you can see it here. Actually, we went from 106% to 96, and that's the multiplier between both values. Trade variation is the number of trades that are removed or added by using the hysteresis. It should never really happen to add. And finally, the hit rate updated from the modification. One comment I've seen, and I have also received via email, is that we should look into updating all of the stats. And the initial idea was to be able to compare the before and after. But now I do see the point, and I think we will be implementing this again in a few weeks' time, because when changing the strategy with the hysteresis, all those values will also change, and it will be important to also keep them updated. We tried at first to only show the most important ones, but now that more people have played with it, I think it's the right choice to simply update it all. And then the 0 point down here is the no hysteresis point, because the alpha and beta is 0. So that could be the comparison point and would be a better way to do it. Now, I think that would do it all. I don't know if there was more. Yes, beta bull, the blue highlights the backtest period that we chose. It is the backtest period, the aimed at backtest period, but it doesn't take into account the days that were trimmed by the thing we mentioned earlier, depending on the strategy. It is like the start and end date that we were aiming for the backtest period. And let's say for most strategies, it is the backtest period. Kevin, I already mentioned this. Okay, well, I think that does it all.
Yes, great. Anyway, it's something we want to. Yeah, what is there any other question?
There was one last question by Natalia that I've seen. Is there a strategy among the 5 that is more universal, something that you will strat with, or just try them all till you see a reasonable area of red squares? I think, Vincent, you'll be best to answer this one.
Yeah, there's a lot of philosophy into that. There's not a straight answer to that. I would say that if we take aside the phase angle, I would say that most of them will lead to similar result. And I think it's normal. They are all price derivative, so it's with some lag into it. So sometimes MACD tend to outperform a bit, and I think it's mostly due to the fact that it uses EMA inside with less lag. It's something that I want to do. Like I said, in the future, I want to do a 2 EMA with zero lag EMA and hysteresis zone. So I expect that this one could outperform. So yeah, phase angle is a bit different. The way it is, it's kind of it was to compensate some flaw of double EMA. It kind of stripped the non-important part of 2 EMA. So one of the main issues is the distance that are accumulated between the two lines can create artificial lag, or actually can make it trigger too often if there's no distance. And that information is not relevant. The thing that is relevant is how fast they curve, and that's what the phase angle measure, and how fast they're going to cross, and how quick. So phase angle kind of are just really mathematically better version. It was conceived to that. So it's sometimes a measure that you can outperform, but there's one issue with it, is in some individual stock, you can rarely like the momentum, because that's kind of a measure of a momentum. The momentum changed too much across the 5-year period. So you end up with a threshold that is just kind of a in between. So sometimes it brings back the phase angle to a more similar level to the other one. So one of the things that we use in the edge strategy, and I think in a future update we'll do, is phase angle looking at a statistic point. So phase angle inside of like the last year of behavior of the stock and how far it is. So in a regular bull market, this is how the phase angle is used in the edge strategy. And I think in this mode, phase angle would considerably outperform the other indicator very consistently. But until then, I feel like MACD Plus might have more chance to outperform, and the other one should be relatively in line. I don't see a lot why a MACD normal would do much, much better than a 2 crossing EMA. And so sometimes the easier is, in that case, can be the best.
Yeah, that was a long answer, but I think it basically means, yeah, look at each of them and try to find what's the optimal point for you. In the end, I think it's easy to just look at the reddest number in returns, but that's not always aligned with how you want to trade. Vincent mentioning earlier that he prefers a lower number of trades and being a bit more quote unquote passive. So you have to take into account your own risk tolerance, your trade style in quote, and what you want to achieve with this investment. So
yeah, and
unfortunately, there's no simple answer.
And I will add also that I know it's always tempting to take the optimal and the historical return, and but don't ignore the simulation filter. There's a reason we do that. There's a reason institutions do that, and there's a reason we think it's a feature that lag considerably into trading view. It's because it's probably, it's not a time machine, so you don't exactly know for sure with that, but at least it can help you strip what might be an aberration of the past. So be careful of that, and sometimes it's probably better to take a point that is the optimal and simulation filter, even though if the stat will not be as impressive in what you will see on historical.
Yeah. There's 3 more points. I will go really quickly because it's almost 2 hours now, and nobody will rewatch 2 hours time. So first, wouldn't it be better, more correct, to show the statistics for the filtered returns instead of the original ones? I'm not sure to exactly understand, but I'll try to answer. The simulation filtered isn't the expected, like the value from 0 to 0.35 right now is not the expected return. It's more, this map is more like a way to filter out the areas from the returns map that should not perform well on the average 1,000 trajectories. So the simulation filtered return map is not showing the returns as filtered, but rather how much confidence we have in a point that it should expect as it had in the history. So the range of the values can change, and the higher the better. You should never see like a big one because that would mean the absolute best filtered simulation point would be aligned with the absolute best historical return value. So it should always range. I think 0.5 is the max I've seen. There's sometimes probably a little more than that. So that's why we do not. It's not a return, so that's why we don't show the statistic on that one. Next, Betable, could you give us the optimal strategies for like 2025 stocks, the most popular one? Again, it goes with what we talked about for Natalia. Choosing a strategy is more complex than just selecting the best point. One feature that was requested is a way to quickly select the highest return, the highest hit rate, the lowest average loss point, like with the shortcuts. And I think that could answer a part of what you're asking. But it is not necessarily, it could be a better way to navigate the interface, but I don't think that highlighting like the 20 best returns is necessarily good. More so that among us return are less expected to reoccur. So maybe they're not that interesting.
Yeah.
So
yeah, and by the way, we thought about that when we designed it because it would be easy to just select the maximum point and then highlight it. We wanted to do it, and then we realized that sometimes it's not the case for Snap here, but what we see on the screen. But for some of the stock, it come with very high level of trading. So we thought that would be misleading people to just highlight automatically the optimal point. But still, compared to testing everything in TradingView, it's still good to see the region which is our very optimal and then being able to see the stat associated. And there's a reason we put it all those graph here is to see if it fit your loss profile, if you're okay with max drawdown that it generates. So
one last question, maybe for you, Vincent. Are strategies with very low amount of trades also robust? There are great strategies with long-term EMAs very close to each other, but they have only a few trades. Do you trust them as well as the other ones?
There's it's yes and no. So the first is, yeah, I think partially if the gauge filter, it's usually those cases the gauge filter will agree with them. And I will tell you why. So like if you go with Apple and you will see, or Microsoft, you will see that a gauge filter is pretty similar to the return. And it's usually going into the very top period. And what's this telling you is that Apple and Microsoft, the best thing you can do is just to hold them. So the fact is, the simulation, the fact that is actually 5,000 of year, if you think about 5 years time, 1,000 of strategy of trajectory. So the amount of instance, if they coincide, is relatively good. The point here is, you're right, it doesn't generate, like the example, the point that Zach just choose for Microsoft generate 4 trades. So basically what that strategy tell you is you're just better to hold Microsoft. So the point is, you need to be careful with this, is there's always one thing that no model can take, not TradingView or anything, into consideration, is the stock will change in the future. And so that's one of the reasons in the future, and that's probably be more long time than the small thing that I told you, but I want to have a stress test behavior. The thing is, those strategy for Microsoft that look at the optimal, if Microsoft completely changed, just think of what Microsoft had a rough 10 year after the dot-com bubble. I would even say 15 years, but so maybe that strategy wouldn't be that good. So anyway, point is, that's more indicative when you see that the optimal is here, that is a stock that is more a buy and hold stock than something you need to be chill. So in that case, you might want to just choose something a bit more reactive, or a strategy just to take your profit, like the 2 ATR that I mentioned, or yeah.
Perfect. So on a closing note, I've seen comments about a Discord channel. What we're looking and have announced with the Advanced is that we will launch a forum that should come somewhere in July. This forum will be for discussions just like we had. Those questions were great, and we really love to read from you, to hear from you, and to exchange. And this will be the place where all of you will be able to post strategies, ask questions, learn from each other, and also help each other. So I think this should answer part of the need for a Discord server. So that was what I want to say. Maybe Vincent, you have closing words.
That was the reason for a forum rather than a Discord. Wanted to have longer posts and people that actually post the interesting stuff they found, and to have more this thing of collaboration. And so I wanted to have an interface where it's more easier to write longer things, insert image and stuff. So that's the reason we didn't went for Discord at this moment. But yeah, because actually what we want is your input. And I will close on that. Honestly, there's a lot of stuff we did into this. It's a lot of stuff to address, so it's really imperfect right now. We did validate the significance, so we are completely comfortable with the result and stuff like that. But I think there's feature we could add, way to visualize. Just for example, one of the first comments we got was to be able to save our preferred configuration. Myself personally, I would like to be able to track some of those configuration, having a place where I can track them. So it's all stuff we would like to add, and I look forward to your input. I think your input is as good as mine on that. So any feature, as you use it more and more, just tell us what you think is missing and we'll consider it. We have a list inside we made of those requests, and so far almost all of them we got was super good.
Yeah.
So
by the way, really long list already.
And partially TuneMap at some point might become a software in itself, but for a Wii U Advance person will always remain. But I think we can build a lot around that. I really plan for the next year to really improve it. So thanks very much for your time. It was longer than expected, but that's probably the things with university professor. We always tend to do a 2 to 3 hour things as I'm geared for giving courses. But it's something we plan to do more. Right now is just to cover the things we could do more webinar, like more advanced. I think there's a lot of stuff to talk into TuneMap. There's other stuff. And it's something also we'll try to do more video to help people understand more our signal. Because we write, but we know it's not everybody that loves to read as much as this. So yep.
And we will collect Q&As across time and build videos for async watching, so it's not always live. And this live stream should be available on YouTube also for rewatch if you want to look at certain parts.
Yeah. Thanks everyone. Thanks for your time. Have a happy Friday. And yeah, a good thing is yeah, stock markets is not going that bad considering how it starts. So happy trading, happy investing. Goodbye.
Bye. Have a good day.